So we'll definitely talk about mini movable factories, but we have to take the audience on a journey. And I think it starts with what we just said here. So let's dive into this a little bit. You believe, and I somewhat agree too, that if you have these warehouses clustered around major, zip codes or areas, then those factories can produce on site and can service that area. Is that where real estate's heading, conventionally speaking? Are we going to start to see, what we're seeing in the catering industry now is this concept of cloud kitchens or ghost kitchens, where big box retail space or old restaurants or whatever are being repurposed, and now you don't necessarily walk into the restaurant and sit down and order food conventionally. You have your third-party on-demand driver go there and pick it up. Are we going to see somewhat of a similar evolution with how construction works? Is prefab going to be meaning not thousands of miles away, but much more closer? How do you see this evolving as an industry?
Yeah, I think that's the right comment. I just think it'll happen a lot slower than we saw the emergence of the ghost kitchens. And that's kind of the constraint of the industry and kind of the big CapEx dollars involved, right? To build out a ghost kitchen, you're spending, $400 or $500 a foot on probably 5,000 square feet. Here, people are focused on building.
It's not a heavy lift. It's not a heavy lift. And you can repurpose a lot of real estate for it.
Exactly. Whereas here, to launch a 200,000 square foot plant that produces some sort of component, whether it's a module, like the box we talked about, or it's a kit of parts, whatever that approach is, those groups are competing with the same warehouse that Amazon can overpay and lease.
And of course, maybe the ghost kitchen analogy doesn't hold here because, that analogy assumes you can put these 5,000 square foot facilities in urban, densely populated neighborhoods. That's not going to work because of the sheer size and scale of these warehouses. So where are these warehouses popping up? Are they popping up in the same places where Amazon's competing for their own distribution and warehouse space?
I mean, I think you can actually answer that given you're an investor in Boxable, right? Because Boxable is approaching it with, that they also have factories, that are leased in warehouses. So I would imagine those warehouses are, similar use cases as Amazon. Exactly.
And sometimes you're building everything ground up and you're bringing a lot of heavy machinery in, and, you've got to work a lot on getting proximity. And I'm sure this is the case here too. Proximity to highway and easy,
exactly.
on-ramp trucks and logistics.
I will say there is one group that we're really fond of that we think is doing this right, but they're focused on one specific subset, in terms of asset classes plus the product they produce. And it's a company out of Canada called Nexi. That company is focused on producing concrete panels for, warehouses, repeatable quality type assets like retail, like Starbucks, right? Where you can just quickly pop up using their panels. It's this concrete composite panel. But the way they've grown is very interesting and very similar to the way we're growing, which is, this local factory approach servicing a certain area where there's a lot of geographic demand.
We're still in the early days, but is there an opportunity here for prospective real estate investors or speculators to go and start buying land and leasing to these large...
Absolutely.
Talk to us about that, because that's going to get some of our listeners very excited.
This is going to be, you'll kind of hear this when we're talking about Cuby and some of the players, right? So let's take a step back for a second. If you look at a lot of the venture-backed groups, right? I think Boxable included, which they've been incredible in terms of the PR they've been able to get and how quickly they've been able to grow, right? And the orders they've been getting from retail investors, et cetera. But what you're seeing is now, say, anywhere from a dozen to 24 venture-backed, call it sticks and bricks technology companies that are innovating in the construction space. They're all focused on raising venture dollars and then spending those dollars to innovate around what they think is the right way to construct. They're also taking on the work of the GC and the developer a lot of times, right? Because they're realizing that it's kind of hard to integrate and sell to those groups, so they have to do everything at once. So I think, though, what they'll realize is the right approach is kind of what we're trying to do and what Nexi is doing, which is for your real estate listeners, they're trying to find, us, Nexi, they're trying to find smart real estate investors that will be the PropCo dollars behind these factories. And these factories will be super high EBITDA producing P&Ls, and then they're just going to license their technology to these factories. And I think that's where the world is going to move.
So much to unpack here. So could you, as we move on to a sort of a different segment here, could you define the word PropCo and OpCo? I'd love to talk about this deeper here.
Sure. I mean, I think there's the simplest analogy. Everyone kind of knows Hilton, right? Before Hilton divested their real estate assets and their kind of brand, right? But the notion of PropCo and OpCo is there's a property holding company that is the physically asset heavy, division or holding co behind those assets. And then separately, there's an OpCo, an operating company that's behind some sort of brand, innovation, et cetera. That's really the, no pun intended, but the operations of the business. And in what I was saying is there's going to be a construction company that's innovative, that's the brand, that's funneling the demand. And then there's going to be someone else that owns the factory and manages that P&L of that factory. And I think you'll see a lot of different factory owners that are all answering to one OpCo brand or technology. So similar to how you have different franchisee owners in a way.
And on the VC side, I'm certainly seeing a lot more PropCo, OpCo, and I think that's a very legitimate path and sometimes a needed path, especially if you've got a very unique technology, but you need the underlying real estate. Well, just go and start raising a fund and go and start bringing in investors and owning the underlying real estate, especially if your OpCo can, bring in the technology, high margins, and produce really good investor returns.
I mean, you and I definitely, that's probably where you and I drive with the most, right? Just in terms of our respective theses is I think there's such a missing cost of capital out there that sits somewhere between venture and real estate. And that's why you've seen a lot of businesses, struggle, think co-working, think co-living, right? Because they're taking high cost of capital venture dollars and applying them to lower threshold real estate returns. And you don't see those businesses scaling well. So I think soon we'll see a big emergence of an asset class that sits somewhere in the middle. Because you have a lot of great businesses. I put our business in that category where, venture dollars don't necessarily solve all the pieces for us. And we're missing a certain cost of capital. And now you're seeing kind of these credit facility, firms like, I-80, Upper 90, One Sharp is amazing, right? So you're seeing these groups kind of start focusing in that ecosystem.
I think what we're really saying here is that there is a fundamental shift in the way prop tech is unfolding, and the rise of the PropCo OpCo trend or structure presents a lot of opportunity. And the current problem is this, to double highlight what you've said, the current capital that goes into PropCo and OpCo isn't well set up for these structures because venture dollars require often very high gross margin, no hardware involved, and venture investors certainly don't want money going into buying real estate. That's definitely not acceptable. And on the other side of things, you've got your typical real estate investors that typically want high cash flow, and they can't stomach the idea that, well, we're investing into some type of private equity real business here. What we're seeing, what I believe is that rather than the VCs and typical real estate funds benefiting from this trend, you've got a lot of special purpose vehicles and family offices that are coming in and sort of are more nimble, flexible, and understand this trend and realize, okay, this is a company that has two very distinct avenues of growth, OpCo and PropCo, right? Both different, but would like to fund the entire thing. And I think family offices are one capital flow that's coming in.
Agreed.
Do you see anything else there?
Well, like I said, I think family office capital is probably the right approach today until we institutionalize this concept that goes beyond just hotels, right? Because if you actually look at hotels, I mean, the PropCo OpCo concept is nothing new, right? Look at Citizen M, for example, great hotel brand. It started by building out an OpCo, and that same dollars that built out the OpCo brought alongside really big PropCo dollars to help it grow. And I think we'll see that emerging across other asset classes. But it's this chicken or the egg that keeps happening. In terms of other capital, I think you're starting to see what the 90s used to hold, which were these CapEx facilities, right? These lease TI facilities that used to exist for retail, and now you're kind of seeing a similar resurgence of that, and you're seeing groups that are producing credit facilities, and like I said, some include the One Sharps, the I-80s, the Upper 90s of the world. They're starting to think in that way, and you're seeing prop tech companies like even the Getaways of the world and the Saunders, right? Even WeWork was getting there, where they're launching these big credit facilities where the first dollars pay for subsidizing some of that borrowed money on the CapEx front.